Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories now we're tracking for you in the BNN Bloomberg newsroom. Shares of Maple Leaf Foods are getting a boost. They're up about 6% right now after the company reported higher fourth quarter profit that topped estimates. Revenue also came in higher than expected. The quarter was boosted by the spin-off of its pork business as well as sales from its prepared foods and poultry units. Maple Leaf says it expects continued revenue growth and further margin improvement in 2026. Shares of Canadian Natural Resources are trading higher. The country's largest oil and gas producer posted revenue that topped estimates in its latest quarter, as well as better than expected profit. The results were helped by a record production that offset weaker oil prices. Output rose nearly 13%, and the company raised its 2026 production forecast. It also boosted its dividend. Spin Master posted profit and revenue in its latest quarter that both came in higher than analysts were expecting. The toy maker also saw an increase in sales in its digital game segment as well as its entertainment segment. On the downside, Spin Master says it expects revenue this year to be flat or in the low single digits compared to 2025. And looking at the markets, an off day after that bounce back yesterday as people try to figure out the situation in the Middle East, in Iran. The TSX off by nearly a full point, 0.94% right now. And south of the border, not much better. Everybody there reacting as well. The S&P 500 off by about a half, the Dow by 1.25, and the Nasdaq by 0.22. And of course, oil prices are pushing higher amid the ongoing geopolitical tensions in the Middle East. But our next guest says the market response to the war in Iran has been relatively subdued for now, and for good reason. Joining me now is Jack Manley, global market strategist at JP Morgan Asset Management. And Jack, thanks very much for joining us. It's been subdued, but it's been a bit of a roller coaster, though.
Yes, it has been. I mean, that's a good way to think about it. There is a lot to unpack when it comes to how we approach this market in the face of conflict in Iran. Geopolitical events typically follow a playbook, so to speak, when it comes to market performance, which is that a geopolitical shock injects uncertainty into the landscape, and uncertainty translates into volatility. Investors brace for kind of the worst case scenario, but at some point, usually sooner rather than later, we realize that all these problems, well, they're happening somewhere else. They're not happening here on our own soil. We kind of go back to focusing in on those domestically oriented fundamentals. The one exception to that rule, though, is when geopolitical shocks impact energy. And that's why what's happening in Iran is so potentially disruptive, right? Iran is itself a fairly large petro state. They have control over quite a bit of the transmission mechanism behind global crude through the Strait of Hormuz. They have the ability to disrupt production in other neighboring Gulf states through attacks. And so as a result of all this, oil prices, as you mentioned earlier, are a little bit higher, and markets have been quite wobbly. At the end of the day, though, I think it is very important to remember that the Western world in general is a whole lot less energy intensive than it used to be. In other words, energy prices matter a whole lot less for economic growth now than they did 10, 15, 20, 30, 40, 50 years ago. You add on top of that the fact that places like the United States are net energy exporters, that countries like the U.S., like Canada, are largely energy independent. It means that energy shocks matter, we'll feel them, but the magnitude of that impact is usually a whole lot less, or it should be a whole lot less than what we've come to expect in the past. Hence, that much more muted response, I would say, all things considered.
Although on a bigger picture, will we not pay? Because even though we're not needing that oil necessarily, the countries that do need the oil are the places we buy things from, like China. And do we not have to worry about inflation with that?
Oil is a global market, and so it does have the ability to filter through into inflation. That inflation can show up directly through the energy bucket that you'll see in, say, a CPI report. It'll flow through indirectly in a number of different ways. You know, maritime shipping costs could increase, airfare could increase, the cost of firing a steel plant could increase. I mean, lots of different ways that it can filter through. Now, that might have moderate implications on discretionary spending, which in turn could push growth maybe modestly lower. But my opinion on this is that it ultimately needs to come back down, not to what's going on with growth, but how it translates into an outlook on interest rates. And frankly, central banks have learned over the last several years, as they should have known for a very long time, that they have no control over supply side shocks. And that is ultimately what we're seeing right now, a supply side shock. So while we may see a little bit more inflation in the U.S. and Canada over the next few months, on top of what was frankly already expected, I don't think it's going to do much to derail the narrative around the interest rate environment. I think the Fed is still likely going to cut once, maybe twice. I think the BOC for now is still keen on being on hold. I don't think conflict and inflation that comes from it challenges that view, which is ultimately what's going to matter most for markets.
All right. And then closer to home, is the bigger issue then for Canada, at least, is it CUSMA? Is it tariffs? Are those the things that could have a bigger impact on this country right now?
I would say yes, if only because they are the wild card, right? I mean, the trade regime really since the start of last year has been wildly unpredictable. It feels like every month there is a new development that changes the calculus on how tariffs are being paid by various global trading partners. Now, my base case for CUSMA renegotiations are a pretty good one. It is in everybody's economic best interest to roll forward a continuation of most of what's made the new CUSMA, the old NAFTA, work so well. And while there's a lot of outward-facing dialogue that may sound discouraging, evidently a lot of the conversations happening behind closed doors are actually quite encouraging, right? This idea that policymakers will let their cooler heads prevail. So it is the risk to the outlook in the sense that it is unknowable, it is unpredictable, it is probably the biggest thing that the Canadian macro story hinges on. But my base case here is a continuation of that existing relationship, more or less as it is right now, which would be, generally speaking, a positive signal for the Canadian forecast.
We had Donald Trump the last time the negotiations happened. There was lots of talk. We ended up pretty much with the same. This time around, does it feel different with Trump, or no? Or are you thinking those cooler heads can convince him?
It feels different in that things are a lot louder now than they were during the first round of negotiations. But we have to remember that there are appointed trade emissaries here that are actually the ones ultimately having policy conversations. They are typically going to be a little bit more level-headed than what you're getting out of, say, the president. We also have to acknowledge here that Canada and Mexico have done a whole lot of talking. The fact that you have a unified front on the other side of this negotiation is helpful. We also have to talk about the fact that Canada has, I think, a disproportionate amount of influence in a lot of these trade negotiations. American access to Canadian timber, American access to Canadian crude, particularly interesting right now, American access to Canadian uranium, which is critical for fueling the nuclear renaissance that the United States is hoping to embark in to help to power all this new AI capability. Despite the fact that the Canadian economy is roughly a tenth of the size of the American economy and that most Canadian exports go to the U.S., the U.S. needs a lot of those exports. And I think Canada will use that as part of their negotiations. And again, hopefully mean that a lot of this blustering amounts to not a whole lot of anything.
All right, we got to wrap it up there, Jack, but thanks very much for joining us.
Thank you.
Jack Manley is global market strategist at JP Morgan Asset Management. Coming up, we'll dive into Linamar and its earnings as the company reported a fourth quarter beat despite the headwinds in the auto sector. That's next. Canadian manufacturing company Linamar has delivered its fourth quarter earnings, reporting strong growth in its mobility business, but margins came in lighter than expected. For more on this, we were joined earlier by Linda Hassenfratz, executive chair of the board at Linamar.
As well, we had really strong earnings growth for the mobility segment, which has a lot of launches going on that are all helping to grow our top line and our bottom line. So we're really happy with where things are going on the auto side, because after all, auto parts are quite different from autos. So whereas the vehicles have tariffs, auto parts, as long as you're USMCA compliant, have no tariffs.
And so you've not been affected directly very much by Trump's tariffs at this stage?
That's correct. Certainly not in the auto business. In the auto business, because everything we do that we ship to the U.S., we make within North America. So that's been a long-time strategy of Linamar to not make parts in Asia or Europe and ship them to North America. We try and stay within the same continent that our customer is. So we make parts in Europe for Europe, Asia for Asia, and North America for North America. So that means if you're USMCA compliant, anything shipping from Canada or Mexico into the US is tariff-free. So our industrial business has some impact. It's not zero, but it's a manageable level, and we're working to mitigate those costs further.
Just remind us of your auto parts / mobility business, revenue-wise. How much is in Europe, how much is in Asia, and how much is in North America?
Yeah, by far the largest percentage is in North America. I mean, if I look at, we have 86 plants around the world, 75 of them are in the mobility business. And of that, 22 are in Europe and just 6 in Asia. So obviously the lion's share of our mobility facilities are right here in North America.
And then you have your industrial business. We know it for Skyjack and those scissors. I think they're another type of lift. And then, of course, agricultural equipment. Can you give us a rough breakdown between your auto parts and your industrial? Which is the biggest revenue and profit supplier?
Yeah, so from a revenue perspective, the mobility business, which is auto parts, but also other types of vehicle on highway and off highway. So it is a blend there. It's not just sort of pass car, but that does represent 75% of our sales at the moment. So the other 25% is split between our Skyjack business, where we make scissor lifts, boom lifts, and telehandlers, and our agricultural business, where we make a whole series of different types of products for the crop cycle, from tillage to fertilization to seeding to harvest and post-harvest. So quite a big and growing business in the ag side.
What about the environment right there? I mean, farmers have been beset by low prices lately. Apparently a big swing will be, or a big determinant of their profits will be, when America gets around to announcing its level of price supports and incentives for the farm sector.
Yeah, the ag business is certainly in a down cycle. It has been for the last couple of years. So typically we're down in the ag markets, then you're kind of down more the next year, and then it starts to improve a little. So we are seeing this year, or expecting this year, to see that, little bit of improvement. When I say improvement, I mean it's not declining as much as it did last year. So the rate of decline is moderating. And we do see that happening through this year even. So starting out the year at a more negative place, and then by the end of the year, we're expecting the market to start moderating in terms of that decline. So that's a positive for the ag business. And in access, the market is predicted to be reasonably flat this year after a big down year in the market last year. Now, the good news is we've been growing market share in our agricultural business and in our access business, and that really helps to go a long way to offset these softer markets.
Just looking at your 5-year stock return here, total return of about 40%, including dividend. Bloomberg is showing a gain in the stock of about 30%. Our chart is showing 25%, but so not too far out. You certainly have outpaced Magna over the past 5 years.
Yeah, I mean, I think that when I look at our longer-term performance, Linamar has a great track record of consistent, sustainable performance. So it really drives out of this diversified model that we've created. We have our auto business, pass car, we've got commercial vehicle, we've got off-highway, we've got the ag, we've got access. And, they don't all sort of work on exactly the same cycles. So as a result, when things are a little soft on the auto side, often things are going well on the ag business and vice versa. So, as I just mentioned, things were a little soft on the industrial side last year, but at the same time, great growth on the auto side. So, in fact, if I look back over the last 16 years, we have grown our top line and our bottom line 81% of those years. 81% of the last 16 years, we've seen top and bottom line growth. And in the majority of those years, it was double-digit growth. Every year that we grew, but I think 2 or 3, we grew in double digits. So that consistent, sustainable growth, I think, is the basis for share price appreciation. I mean, we're delivering year after year after year, continuing to build market share, winning new business. We had a great year for new business wins last year. Our Canadian plants, as an example, had an outstanding year. They won more new business in our mobility business and our auto business than we have in the last 3 years. We won last year in 2025. So we're pretty proud of that.
Andrew, we're speaking with Linda Hassan-France, Executive Chair of the Board at Linamar. Coming up, oil prices continue to surge as the war in Iran intensifies. What it means for the sector next. Oil prices are pushing higher as tensions in Iran intensify. You can see they're up again today after being flat yesterday, maybe down a little in places, up 6.66%. Hopefully that's not a harbinger. Up nearly at $80 a barrel for WTI. All this, of course, about concerns about supply, demand, the ripple effects across the global markets with the war in Iran. Traders are especially focused on the Strait of Hormuz, where any disruption could have far-reaching consequences for global energy flows. To break this all down and what it means for the sector and beyond, we're joined now by Cole Smead, CEO and Portfolio Manager at Smead Capital Management. Cole, thanks as always for joining us.
Thanks for having me.
I was just looking at one of the marine traffic maps. Some ships are getting around the corner on the Strait of Hormuz, but there's not many. Is that the key, that strait right there? Is that kind of, if that can get opened up, will people exhale a little?
Yeah, it's a really good question. It's a very odd dynamic that's going on between the interaction of the state of affairs in the Strait of Hormuz, or just call it the geopolitics that we're looking at on the map and in our administrations, versus what's going on in security markets. What security markets have done so far is faded the idea that this will be a longer conflict, longer being, say, anything more than a couple weeks, which is odd. So I think it presents a real tail risk to markets. To your point, I mean, we own Frontline, which is one of the oil tankers. It's the largest oil tanker publicly traded out there, that's ran by John Frederickson. And it's a business that, gets paid on a per day basis to be moving oil or keeping oil on water, et cetera. And you're seeing this big spike in the cash markets right now. At the same time, the question is how many boats want to go out and move. Who those boats are typically moving oil for is countries like India and China. And so as we hear the developments of, say, the United States providing naval and insurance backstopping to the markets that cover these tankers, you have to remember a captain's job is typically to ensure the safety of his crew or her crew and the boat. And that is the starting point for most seafaring adventures. And if you can't do that, the insurance is the second thought. Does the boat owner want the boat running? And is it cheap enough to ensure that process? And so I think what it's doing is it's taking the United States and putting them into the policy of protecting foreign countries' oil flows and ensuring foreign flag boats in order to keep the price of oil lower, but trying to have success in Iran and keeping oil prices lower are just paramountly adverse to each other. and therefore what's going to give.
And you don't think it's possible that they can keep the boats moving through there and also win the war against Iran that they started with them?
Yeah, I believe there's a savior, but I don't believe in fairy tales. Okay, and I say that because the idea has been that because the United States had its swift success in places like Venezuela, with obviously ties to oil, that we are this surgical tactician. We are a very powerful country, but we're running into what's referred to as the escalation trap. It's the same thing that was seen in Vietnam, that once you provide presence and you become to show force, that force in your mind continues to grow bigger and bigger and bigger. And the escalation trap, or some call the smart bomb trap, bombs and wars change the minds of the people on the ground. And that ultimately for regime change is what you need. You need the hearts and minds of people on the ground to change. And there's already discussion of putting special forces on the ground. So the escalation trap looks like it's following its curve. Really from a political or military perspective, this is fighting the arc of history for cleanliness. And so what we don't get is why investors think this is just going to be this cute little adorable conflict, and therefore are fading the securities that benefit from the near-term disruption of this, but really shows that the oil markets aren't nearly as, there's not the glut that was claimed, and these tensions show that this is a much more fragile system of over 100 million barrels moving the earth every day.
So how are you playing this then? What are you doing with it?
Sitting on our hands and waiting for people to give us better prices on many of the securities involved in this. So I mentioned we own Frontline. Frontline is collecting daily cash rates that have gone up. That being said, if you look at the supply, historically speaking, we did some rough math. There's about, even if you include dark fleets in that matter, there's about 16 years is the average duration of the boat that's out there floating legally or illegally. That's about a 6% depreciation rate. And so if you said, well, what boats are being built in Asia today? It's roughly 3%. So we have this supply demand imbalance being provided to that market. So I think the real question is, how long does the tanker fleets really over-earn going forward? Because these risks, you get paid for risks in this life, and therefore we're going to see them over-earn for a season. So how much more added income we'll get from that? Other names would be, we own the Canadian E&Ps, we own Cenovus, we own Strathcona. Newer name to us would be like International Petroleum. This is a great torque market for those players, particularly like an International Petroleum or a Strathcona. And so the torque that will go from higher oil prices affecting free cash through the operating leverage of these fixed assets, we think is very attractive for investors. Now, mind you, look at global indices. To quote the Monty Python, "'tis merely a flesh wound from a sector perspective." So investors are heavily underweighted. The piper is playing a song, and they're going to have to pay the piper here soon if this goes on a lot longer than people expect.
All right, Cole, we'll have to wrap it up there, but thanks very much, as always, for joining us.
Thank you so much.
Cole Smead is CEO and Portfolio Manager at Smead Capital Management. Just ahead, we'll put the spotlight on the electric vehicle industry as Windsor's Nexstar battery plant pushes ahead with business as usual despite an EV slowdown and Stellantis exiting the project. Home sales in the Greater Toronto Area declined in February as both buyers and sellers remained on the sidelines. The Toronto Regional Real Estate Board says more than 3,000 homes were sold during the month, down more than 6% from a year ago. The average selling price also fell 7% to just over $1 million. The board says if listings continue to tighten this spring, competition among buyers could pick up, pushing prices higher later in the year. Kinaxis is the best performing stock on the TSX today. The supply chain management firm saw revenue surge 16% versus last year and top estimates. Profit also came in well above consensus, and the company's full-year revenue outlook was better than expected. Robust demand and record booking also fueled the quarter. Analysts note the results signal strong momentum. Shares of Tourmaline Oil are seeing some pressure. The company achieved record production in its latest quarter, but posted profit and revenue that fell short of estimates. Tourmaline also announced that it sold its natural gas assets in northwestern Alberta for $765 million. The company did not disclose the buyer, but says it is a senior Canadian producer. It plans to use the proceeds to reduce debt and build infrastructure in British Columbia. Taking a look at the markets. Another down day after the upturn yesterday. Oil driving this right now. You see the TSX is up by 1.31 with the oil prices rising. South of the border, really not much better. About the same, in fact. I mean, S&P 500 up by 0.75, the Dow by 1.6, and the NASDAQ is off by 0.4. Canada's first and only commercial-scale EV battery manufacturing facility is celebrating its grand opening today. For more on this, we were joined earlier by CTV's Jeremy Sherrill.
Battery manufacturing plant. It is a massive facility. We're talking about 4.23 million square feet. And the company says already it has invested 5 billion Canadian in the economy through this project and added direct 1,300 jobs. It's expected to continue to scale up eventually to reach 2,500 jobs. This was a joint venture between Stellantis and LG Energy Solutions in terms of ownership of this battery manufacturing plant. Stellantis has recently, just in the early months of this year, chosen to go off in a different direction. And so this is solely owned now by LG Energy Solutions. But we're talking about a plant that is producing lithium-ion batteries suitable for both EVs and for energy storage systems. That's where LG, of course, comes into play. Stellantis will remain a customer and will purchase some of these batteries, but is no longer an owner of this facility. But this is significant in Canada's establishing of an ecosystem around not only EVs but battery manufacturing, and an impact it could have down the line on EV manufacturing in the country as the federal government kind of changes course on its approach to incentivizing companies to manufacture more EVs. We've seen a bit of a fracture in the North American auto sector. The U.S. has been clear it is prioritizing its own interests. We're no longer looking at kind of this North American auto sector. Rather, we're seeing companies really prioritize themselves in the U.S. Stellantis, for example, shutting down its Brampton plant and moving the production of the Jeep Compass to the U.S. As a result, Canada is looking to adjust, right, Andy? And so I think this is, this company is saying that this will be a crucial piece to the ecosystem down the line as Canada looks to, shift to prioritizing production and manufacturing of more EVs here in Canada.
Certainly, there's been so many blows for automaking in Ontario. This EV battery plant looks like a ray of sunshine at this stage.
Sorry, I missed the last part there, Andy.
Sorry, this EV battery plant is a bit of good news after so many losses. Yeah, sorry, go on.
Yeah, absolutely. No, to your point, we just talked about Stellantis' Brampton plant moving, and so this is certainly welcome news, and I think for the industry, and I think when you look at what the Canadian government has announced in the last little bit in terms of investing in just last month millions of dollars in new EV chargers across the country, 8,000 new chargers across the country, and the deal that they've recently signed with China to bring in more Chinese EVs, but also pushing for joint ventures between Chinese manufacturers and Canadian companies to establish supply chains here in Canada. A plant like this that is manufacturing the batteries could be crucial, again, to that ecosystem down the line.
And that was CTV's Jeremy Sherrill. Coming up, women make up a sizable share of the workforce, but many face a gap in their earnings after children. We'll dive into that after the break. International Women's Day is Sunday, and we are seeing some noteworthy signs of progress in the wage gap. But my next guest says there is still a long way to go in reducing what's called the motherhood penalty. Here to tell us more is Catherine Judge, Executive Director and Senior Economist at CIBC. Catherine, thank you very much for joining us.
Thanks for having me.
All right, let's talk about the report and just what exactly is the motherhood penalty.
So we are seeing some encouraging signs in terms of women with young children increasing labor force participation and increasing their contribution to families' earnings shares. However, when you look at women with children versus women without children, there's still a sizable earnings gap. So we looked at long-run motherhood penalties, and that's essentially the gap from the time that the first child is 5 to 10 years old. And that gap in Canada is on average 34%. So women with children are earning 34% less on average during those years than women without children. And that is much higher than in countries that have very accommodative parental leave policies, places like Sweden, where you see the gap at around 20%.
And is it strictly because of that then? Or are we seeing more equity? Are we seeing, in those countries, do we see more men staying at home as well?
So there are a few factors at play. There is research that shows in Canada, when subsidized daycare was introduced in Quebec in the late 90s, the motherhood penalty was essentially cut in half. Now, if we look at daycare enrollment rates in Canada, all provinces still trail Quebec greatly. So we know that increasing childcare enrollment engages mothers in the labor force better and narrows the gap. And then there also is the issue of unpaid childcare and household work, where women tend to do more. So women that are aged 25 to 44 do about 2 hours per day more than men on those tasks, which of course cuts into time that could be doing paid work. And we find there's a prominent body of research that suggests women are willing to trade lower paying jobs for more amenities and more flexible hours at work. And that's also tied into the what's called the fatherhood premium, which is where men actually can benefit after a child is born by earning more because they choose to work more hours. So there are a lot of factors at play here.
Are we seeing more, as more women make more money and rise up the chain, are we seeing more men staying at home, and are they suffering a similar situation, or do you have those numbers even?
So you are certainly seeing more men contribute to the unpaid household childcare tasks that I was speaking about. If you look back a generation ago, the gap has closed, has essentially been cut in half. So that, in our view, is part of it. If you look at the earnings of men and women pre-children, they evolve essentially in the same way. And then there's an immediate drop in earnings for women, of course, that go on maternity leave. In the case where the woman has one child, the earnings penalty essentially goes away by the time the child is 10. But for women who have 2 or more children, the motherhood penalty is much more persistent and carries on much longer. So one factor, of course, would be equalizing those unpaid tasks, which would free up more time for women to pursue career development.
And you mentioned about the daycare. Are there other things that might make a difference, too, to close that gap?
Yeah, so one other thing we looked at is flexible work, which is defined essentially as industries where 35% of employees have adaptable hours. And we see that women's growth in employment is overwhelmingly concentrated in flexible industries. So that's another factor, of course, to consider. But I think the low-hanging fruit here is the continued expansion of subsidized daycare and getting those daycare enrollment rates up closer to what we see in Quebec so that we can lower these penalties in the rest of the country, because the fact is that we're just not utilizing the workforce to its fullest potential here.
And I mean, we saw that huge boom with work from home at the start of the pandemic. It's carried through. We're starting to see people come back to work. Has that had an influence as well, or is that essentially the flexible hours? Is that looked at as the flexible hours you mentioned?
So when you look at participation rate gaps, so for women with children under 6 versus women who don't have children under the age of 18, there's been a narrowing in that gap that started in 2019. There was a significant narrowing, so that does suggest that remote work and more flexibility was a contributing factor, although we don't have detailed data on that.
Okay, so and so we might actually see a dip again then, if as more and more people have to go back to work, and it seems like the women are going to have to make a choice on if they want to go back to work or not, or stay home.
I think it's really about focusing on within couples on, sharing the childcare and unpaid tasks more equally. That's been shown to make a big difference, but there are a lot of factors at play here. But I think it's pretty nuanced in terms of each family's situation. We're still seeing, of course, the effects of subsidized daycare that has not fully been realized yet. And I think we will get positive impacts on women's participation as that continues to roll out.
And then overall, what's the gap between men and women? I mean, can you do it as a general? What is that at now?
So there is in Canada, the long run's earning gap in terms of the motherhood penalty is 34%. And then there's also the parental gap, and there's the gender wage gap, which of course persists. We have done prior research into the wage gap that shows essentially women aren't being increasingly represented in managerial roles. So it's really about breaking that glass ceiling to narrow the wage gap further, because if you look at prior years, progress on that really has slowed down.
Okay, we have to wrap it up there, but Catherine, thank you very much for joining us.
Thank you.
Catherine Judge is Executive Director and Senior Economist at CIBC. When we come back, we will talk more about the Prime Minister's trip to Australia and how the markets are reacting to tensions in the Middle East. Prime Minister Mark Carney is in Australia, and for the latest on that trip, we go to CTV's Abigail Beeman.
A warm welcome down under.
The distance between our two nations has never mattered less, and the closeness of our values has never mattered more.
In the Parliament of our shared Westminster system, Prime Minister Mark Carney highlighted many ways Australia and Canada are similar.
Two proud democracies, the true north and the land down under.
Carney spoke of coming to reaffirm the alliance as global architecture is breaking down in consecutive crises, and gave many nods to his well-received Davos speech.
Every agreement signed, every coalition deepened, every commitment made is variable geometry in practice.
And he announced Australia is signing on to the G7 Critical Minerals Alliance. Plus, there are new partnerships on AI and defense.
We're actively exploring new opportunities to protect our vast territories.
Canadian soldiers will begin training on the new radar Canada is buying from Australia later this year.
The world will always be driven by great powers, but it can also be shaped by middle powers that trust each other and act with speed and purpose.
After wrapping up his second Australian stop here in Canberra, Mark Carney heads to Tokyo for the final leg of his Indo-Pacific trip.
And that was CTV's Abigail Beeman. Now, for more on Carney's trade trip to the Indo-Pacific region and the Canadian reaction to the war in Iran, we were joined earlier by Hap Snedden, President and Chief Portfolio Manager at Castlemore.
We've always been sort of a middle power, but when we look at maybe how we've interacted with the world the last 15 years, we might be on the lower end of middle power. I can't speak for Australia, but, how do we become relevant in what's going on? And certainly, not being privy to the initial strike and the offensive nature, some supporting coalition, I imagine, is going to sort of develop, and then we're going to have to sort of do our bit there. And as I said, we sort of spent 10, 15 years out in the wilderness a little bit as far as relevancy on the world stage, I think.
And we're starting to come back. I mean, and the challenge with this, there was a missile launched at Turkey. Turkey is NATO. We're tied to, we have to honor the NATO agreement we have. But we don't want to be seen as being too rah-rah, or at least it feels like Carney doesn't want to be seen as being too rah-rah about the war in Iran itself.
Yeah, just look at Spain. You sort of had this back and forth. Okay, the strong statements from the Prime Minister yesterday, and then later on the U.S. administration saying, well, they've come our way now, and then again this morning no, we didn't. So, and they're NATO as well, right? So, I would think that Russia and China love that there's this not a cohesiveness inside NATO, and I think all NATO countries have to sort of be mindful of that, and certainly getting ringing Iran is good. The way it gets done, all that is open for debate, but it's certainly the world's a safer place.
Yeah, I think most people would agree with that. A lot of Iranians would probably agree with that for sure.
Yeah, that's been understated, I think. Really understated.
But it is a difficult balance between going into a country and with regime change and disagreeing with them. What about from the economic side, from what we've seen so far on this trip? Would you call it a success? Some of the deals we've seen signed with India and now Australia? Yeah,
I think, and you guys are right here at BNN. You're right at the forefront of the news hitting, and we're pretty close to Castlemore, but it hasn't sort of made it through to being substantive. I think time will tell, and as I said, we have a lot of work to do to sort of be relevant to what are we on the world stage. As far as the deals go, I think they will they will bear fruit. When we look at the market that we're in right now, we're sort of moving away from that super pro tech. And I think tech is going to, we'll probably talk about it throughout the hour, but tech is sort of coming back. Certain parts of it's all not changed. We're all not going to go to, commodities and, things have shifted where we're going to see a little bit of strength in the Canadian dollar. We're going to see some of the stuff that Canada does, exports, produces to be in favor. And, Australia, very similar, trying to probably find some kind of harmonies between two somewhat similar economies.
And that's one of the things we have seen is with the dollar, right? It's because of the energy, right? At least right now in this moment, the U.S. dollar has gained, and we've kind of ridden along with it. Yeah,
exactly. The dollar. When you look at the band, we're sort of in this band here. We're kind of trying to push up to the upper part of that band, and to get through that would be what all the things we're talking about really matter. But we always have to remember, with the Canadian dollar, it's always about the relationship to the U.S. dollar. When you talk about the U.S. dollar, it's always in terms of the world, the U.S. dollar index, right? There we got a spot dollar there of the U.S. dollar index chart. But the Canadian dollar is always referenced to one currency, the U.S., where the U.S. is always to the basket and the world that. And so we can see here in the U.S. dollar there, we had a little bit of a down move there. This has really had a big impact on gold, all those precious metals, and this little upturn here we're seeing is quite interesting, right? Is this going to sort of break that downtrend that we've saw down here, or are we going to kind of go all the way back there to April of last year, and or is it going to be sort of capped? So the U.S. dollar, I think we're going to see a bit more strength. You might see that luster in the gold start to come off a bit, just because that's the biggest relationship between gold it's the U.S. dollar. It's not a safe haven. It doesn't really do much for.
Sorry, gold or a dollar is not a safe haven.
Gold.
Gold. Okay.
We always think it is. The time we run now, there's always an initial reaction, but if you go back and look at the tape, the history, that initial reaction fades. It's an asset to be sold in times of uncertainty, but there's an initial reaction. The U.S. dollar, though, however, is that safe haven, and historically has been that. And so the relationship between the U.S. dollar and gold is pretty obvious when you go back there and look. And so, there we have the gold futures there. That's been pretty significant, almost the exact opposite of what we saw in the dollar.
And that was Hap Sneddon, President and Chief Portfolio Manager at Castlemore. Market Call is coming up next, and today on the show we have Ryan Modesto. He is the CEO and Portfolio Manager at I2I Capital Management. He will be taking your questions on North American stocks. And Let's take a look at the markets. I'm not sure we want to right now. Another down day as oil surges again. The TSX Composite overall is off by 1.23%, down now well below 33,500 is where it's heading to right now. And driving that, if we look at the groups, it is not surprisingly, it is the materials index off by 4.35%. And some big losers, Capstone Copper, Arrow Copper, First Quantum down there, down by 7, 8, 9%. Going the other way, though, there are some winners actually today. Let's take a look at CNQ, up 2% after a beat on its EPS on production. So it's rising. At one point, it was up as much as 4%. Analysts seeing this as the results of positive, with fourth quarter cash flow beating, production being in line, and the 2026 capex guidance being cut. Another winner for today, right now, at least at this point, Linamar, and it's up. I think anybody will take a victory today. At one point, hit an all-time high on the fourth quarter beat, so it's up about 1.69%, 93% for the year. And Maple Leaf Foods, another one, taking a quick peek at, worth mentioning. It's up 6.86% again on some strong revenue ROI in Q4. They gained as much as 6.3% on their biggest intraday increase since August. They beat the fourth quarter adjusted earnings, beat analysts' expectations. All around, some good news from Maple Leaf Foods. But south of the border, we can pull up quick if you want to take a quick peek. I'm combining words at the American markets. I'm making up words as we go here. U.S. markets, you can see they're all off 0.64 for the S&P, Dow by 155, and the NASDAQ by 0.3. Thanks for watching Morning Markets. We'll see you back here tomorrow.